The Standard & Poor's 500 gained 2.4% in the second quarter of 2013, following the first quarter's unusually strong 10% gain. The index of America's large blue-chip companies was up 12.6% for the first half of the year. For the second quarter that ended June 30th, the Standard & Poor's 500 showed a total return of 2.9% with dividends included, and a total return for the first 6 months of 2013 was 13.8%. The stock market's strong performance came as a surprise to many. Fears that the economy would be slowed by a federal tax hike that went into effect on January 1 were shrugged off by investors. An $85 billion cut in federal spending imposed by the sequestration early in 2013 also did not stop the bull run. The 2.4% gain in the second quarter was the best second quarter performance for the Standard & Poor's 500 stocks since 2009, and it came on the heels of the first quarter's unusually strong 10% gain. The S&P 500, a benchmark of the nation's largest publicly held companies, hit a new all-time high on May 21st, but it retreated by 3.8% by the end of the quarter. Of course, the stock market's performance over a quarter or two is not as important to investors as longer-term periods. In 2008, stocks had peaked and begun a frightening descent that decimated portfolios of many retirees and retirement savers. The 5-year total return on the S&P 500 index makes clear just how much the U.S. stock market has appreciated since the lows hit in the aftermath of the financial crisis of 2008 and 2009. In the throes of the financial crisis, some investors became convinced the stock market might never recover or that a recovery would take many years. The investors who abandoned stocks have totally missed out on the 135% appreciation in the S&P 500 since its March 2009 low. This is a snapshot of the performance of U.S. versus foreign stocks during the second quarter. While U.S. stocks performed well, concerns lingered in Europe about the cost of a bailout for Greece, Spain, and Portugal, and Europe's larger economies remained anemic or in recession. It was bad for stock prices. In Asia, Japan struggled to liquefy its economy, and the government resorted to a drastic monetary stimulus program, which showed hopeful signs of jolting the Japanese economy out of its 2-decade malaise. Stocks remained weak. China, the world's second-largest economy, suffered a sharp slowdown in economic growth, and share prices fell. The very respectable 2.4% appreciation in the S&P 500 in the second quarter was outdone by one category. Small company stocks surged 3.6% in value. The poor performance of foreign stock markets has held back returns on globally diversified portfolios. But that's a price investors pay for properly diversifying. Your portfolio never performs as good as the hot asset class. U.S. stocks also outperformed foreign stocks in the 6-month period that ended on June 30th. Investors in the broad indexes for Asian and European stocks eked out gains, while indexes for stocks in China and emerging market nations landed investors for significant declines. The 5-year period ended June 30th, shown here, is a long-term cycle, which is what investors care most about, and in that period, U.S. stocks streaked ahead. Buy and hold investors who adhered to investment policy statements through the financial crisis have been rewarded. Tolerating the historic bear market of the 2008 financial crisis has paid off. Even if you had the worst possible timing and invested in the S&P 500 stocks in October 2007, just before the global financial crisis erased 40 or 50% of the value of many retirement accounts, you'd have recouped all your losses by the end of this quarter, and your portfolio would have grown, modestly but near the historic norm. This is perhaps the most important lesson investors learned from the 2008 financial crisis. This slide and the following two analyze segments of the U.S. stock market by divvying up U.S. publicly held companies based on their valuation and market capitalization. The big story for the second quarter was small company stocks, specifically bargain-priced or value investments in small caps. Look at the outperformance by small-cap value stocks, the top-performing segment for the quarter, over mid-cap value stocks, the worst-performing segment. The fractional return on mid-cap value companies versus the 4% gain on small-cap value companies illustrates why proper diversification can be so important in retirement portfolios. At the start of the quarter, no one could have known that small-cap value stocks would appreciate so much more than mid-cap issues. Because no one can reliably predict such things, it's wise to avoid bets on a single segment of the stock market or on a single asset class like stocks. Put another way, diversification is so very important to investors. In the 6-month period that ended June 30th, even the worst performing segment of the stock market provided strong returns. Large-cap stocks appreciated in value by 11%, while small-cap value companies, the best-performing segment of the U.S. stock market, appreciated by 15.7%. To gauge just how good a 6-month period this was, consider this. Stocks averaged about a 10.5% 12-month return over the last 76 calendar years. So, a 10.7% return in just 6 months is indeed a strong showing. Keep in mind that the 10.7% return was earned by the worst-performing segment of the stock market over these 6 months. The 5-year performance shown in this chart underscores why methodically diversifying and rebalancing are so important. Look at how small and mid-cap companies dramatically outran large-cap companies. This, of course, does not occur in every 5-year period. In some 5-year periods, large-cap companies outperform small companies and mid-caps. Examining industry sectors reveals another wide dispersion of returns. Financial, consumer discretionary, and healthcare shares came out on top, while utilities, companies producing raw materials, and energy-related companies suffered declines. In the first half of 2013, the top-performing industry groups were stocks in the healthcare, consumer discretionary, and financial service industries. And the lagging industry sectors were technology, utilities, and materials stocks. It was widely accepted after the financial crisis that consumer discretionary spending couldn't possibly rebound anytime soon, given the persistently high unemployment rate and mountain of household debt hobbling the economy in 2008 and 2009. But the American consumer has proven far more resilient than most analysts ever expected. In fact, rather than languishing, the Consumer Discretionary Sector Index have been the best performer of the 10 S&P 500 industry indexes over the past 5 years, and by a wide margin. Meanwhile, technology stocks, the perennial favorite among Wall Street strategists, have been a consistent laggard. The different types of asset classes, represented here by exchange-traded funds and indexes, also show a huge disparity in returns. S&P 500 stocks and MLPs, master limited partnerships, in the second quarter gained in value again, coming off strong gains in the first quarter. Gold was clobbered. Gold bulls have argued for many months that the Fed's easing policy will inevitably result in rampant inflation. But this scenario has not come about, and inflation remains in check. Commodities took a hit, principally on concerns that the Chinese economy may slow more than expected. Bonds and REITs were hit hard. Fed Chairman Ben Bernanke, in a June 19th press briefing, said the central bank's monetary stimulus program, known as quantitative easing, could be completely wound down in 2014. Cumulative returns on major asset classes in the 5 years that ended June 30th shows that master limited partnerships, an asset class that barely existed 5 years ago, has outpaced other asset classes by a wide margin. Bonds, Treasury, and high-yield issues were 5-year leaders among major asset classes, replacing gold. The recent rise in interest rates has hurt the 5-year return on bonds. Since bonds play a crucial role in diversified portfolios, let's for a moment look at fundamentals driving the bond market. Bond yields jumped in June, and the most noteworthy event of the second quarter of 2013 was a June 19th press conference by Ben Bernanke, Federal Reserve Chairman. If the economy continues to improve, Bernanke said, the Fed would start to slow its quantitative easing program for keeping interest rates low. About 8 minutes into the 10-minute statement prefacing a 1-hour press conference that regularly follows monthly meetings of the Federal Open Market Committee, Chairman Bernanke said the pace of the central bank's $85 billion per month asset purchase program, dubbed quantitative easing, would probably be tapered off in late 2013 or early 2014, and could end completely by the middle of 2014.
The committee currently anticipates that it would be appropriate to moderate the monthly pace of purchases later this year. and if the subsequent data remain broadly aligned with our current expectations for the economy, we would continue to reduce the pace of purchases in measured steps through the first half of next year, ending purchases around mid-year. In this scenario, when asset purchases ultimately come to an end, the unemployment rate would likely be in the vicinity of 7%, with solid economic growth supporting further job gains, a substantial improvement from the 8.1% unemployment rate that prevailed when the committee announced this program.
This is arguably the single most important picture for investors to focus on. The green line shows the value of the S&P 500 index of 500 blue-chip U.S. companies, and the purple line shows the profits per share averaged by the 500 companies in the index dating back to 1988. Corporate earnings are the single most important determinant of stock prices. The red markers in the upper right corner show that the consensus forecast of Wall Street analysts for earnings on the S&P 500 stock index as of July 24, 2013, was for $111.05 per share for 2013 and $123.59 per share for 2014. That earnings forecast, which seems reasonable given the recent strength of the economy, would propel the price of the S&P 500 in 2013 and 2014 in the trajectory shown in the red square markers. If the economy continues to grow, as the Fed's staff of economists and private forecasters recently predicted it would, then corporate earnings are likely to continue on the trajectory shown. If stock prices always follow earnings, this would be good for stock prices. It's important to note that in the period of irrational exuberance around 2000, stock prices shown in the green line and corporate earnings shown in the purple line did not stay correlated. That gap shows a classic example of how stock prices can become disconnected from fundamentals due to human emotion. However, if you look at the relationship between the green and purple lines now, stocks are actually trading at the low end of their historical valuation relative to earnings. Keep in mind, the red squares are not meant as a prediction of where stock prices will go. Unexpected events could derail stocks from staying on track. But barring some major event like that, the trajectory of stock prices remains favorable, and economic growth at the end of the second quarter appeared to support this trajectory. Outside of the U.S., Europe's leading economic indicators picked up in the second quarter, while China's slowed. The Organization for Economic Cooperation and Development, a group of 34 developed countries, in its May 2013 Global Economic Forecast, said it expected gradual acceleration in major economies and world regions through 2014, except in Japan. A relatively shallow recession was expected to persist in Europe through the end of 2013, with a return to expansion in 2014. In China, the world's second-largest economy, monetary authorities are reining in on credit expansion. Economists have nonetheless been forecasting faster growth in 2014 than 2013. Meanwhile, the U.S. economic outlook, as measured by gross domestic product, remained bright as the second half of 2013 unfolded. The Wall Street Journal monthly survey of 50 top economists, illustrated in the purple bars, show the recent forecast for continued growth in gross domestic product. In the July survey, the consensus view of economists was for gradual acceleration of economic growth through the rest of 2013, despite the fiscal cliff weakened fourth quarter of 2012. Economists warned that the economic expansion in the quarters ahead would trigger rising interest rates. The Conference Board, in a June 20th release of the nation's leading economic indicators, said gains in the leading indicators in the first half of 2013 suggested upside potential for economic activity in the second half of the year. If you have any questions about this presentation or how we can assist you, please contact us. If you would like to receive more of our special reports, please connect with us on social media or sign up to receive our newsletter.